Hi, my name is Connor Taylor.
My name is Nathan Gunther.
I'm Roy Bohannon.
And I'm Kayla Miller. For our project, we decided to talk about Silicon Valley Bank. If you don't know what that is, it's a banking company with over 20 branch locations and a headquarters actually located in Santa Clara, California. The story of how SVB came to be is actually an interesting one. And all of it is documented on their website where we got a chance to really read through a little timeline of their life. It was first established during a game of poker, and this dream quickly became reality, and SVB was established in 1982. When it was established, it was mostly created to provide banking services and credit to Silicon Valley startup technology companies, and it actually would eventually become one of America's 20 largest banks. Roger Smith was the first CEO, and he kind of began this clientele of small startup companies, which was originally during this time an overlooked market. And although it was a good idea at the time of establishment, primarily focusing on this small startup target market and not including a diversity of the clientele would actually cause problems further down the road. Historically, Silicon Valley Bank has provided support to more than 30,000 companies to aid them in their innovation and success. And they have actually managed trillions of dollars in capital as well. They've expanded their products, their services, and have become one of the largest, best performing banks serving the technology industry. And they have actually even been able to expand internationally, which is really cool. And they did this through venture capital relationships. Unfortunately, SVB has recently gone through a major shutdown, which is the reason for our presentation today. So actually back in March of 2023, so this year, SVB was faced with several problems that led to a growing panic among their clientele. These problems included an increase in interest rates, fewer depositors, poor investment practices, and as I mentioned earlier, a lack of diversity among their client portfolio. And then within 24 hours, SVB faced a combined withdrawal of $42 billion in assets and investments, which not only jeopardized the interests of stakeholders, but actually impacted the global financial system as a whole. They were forced to close their branches in order to try and figure out what went wrong, and ended up uncovering several red flags, as they call them, that could have helped to prevent this crisis if they had kind of found it out earlier. According to a news article written by Allison Morrow for CNN, actually, these red flags included things such as inadequate risk management systems, a high percentage of uninsured deposits, young startup clientele, as I had mentioned, and the fact that SVB actually had no chief risk officer and hadn't had one for months. Since then, they have been called the second largest bank failure in US history. And so our project is kind of to analyze the shortcomings within Silicon Valley Bank and provide recommendations on how to prevent a collapse like this from happening in the future. And we also hope to answer two big questions. One, what could Silicon Valley Bank have done differently to have prevented this shutdown? And furthermore, how can multinational banks such as SVB incorporate more transparent management and financial practices that protect stakeholder interests?
Yeah, so for our research, we looked at some of the other bank failures in recent memory. Bank failures aren't exactly a new phenomenon in the US economy. They have been a common result in recessions, including the Great Depression, the banking crisis of the 1980s, and the Great Recession of the late 2000s. In 2008, during the housing bubble, IndyMac was a large bank with over $32 billion in assets. According to an article by Isidore in 2018, Congress questioned the ability of IndyMac continuing operations, which led to a bank run causing the bank to close. The fourth largest bank failure in United States history at the time, the failure of IndyMac triggered a string of bank failures. This eventually led to widespread panic relating to financial institutions, causing many lenders and investment banks to close or lose billions of dollars. As you can see from the graph from FDIC's bank failures in brief, from the beginning of 2005 until IndyMac failed, only 6 banks had failed in the United States history over almost 4 years. However, in the year following IndyMac's failure through the end of July 2009, almost 90 more banks failed in the United States. Fast forward to 2023, and we're seeing an alarming rise in bank failures once again, almost as large as the failures of the Great Recession. But this rise is not a combination of more than 300 banks over 3 years, like in 2008. Instead, it is a result of 2 banks failing over the course of 3 days this past March. Silicon Valley Bank was the first, followed by Signature Bank of New York. While these 2 bank failures do not necessarily indicate another recession or financial crisis, they could be a sign of potential economic problems to come. So now we will move into our recommendations for Silicon Valley Bank. The primary objective is to establish effective procedures and policies that instill confidence in the bank from the perspective of its customers, employees, and other stakeholders. First, it is recommended that the bank subject itself to stress tests similar to those required of banks of similar size before the 2018 bill that loosened regulation and oversight on financial institutions in the United States. These stress tests would enable the bank to continuously monitor the performance of its funds, investments, and loans under adverse economic conditions. If Silicon Valley Bank had conducted these regular stress tests, it would have discovered the potential risk posed by its excess investment in United States Treasury bills, particularly in the event of a hike in interest rates. While Treasury bills are traditionally one of the safest investments, a rise in interest rates could lead to significant losses if too many depositors try to withdraw funds. By implementing policies and procedures to hedge investments and conduct stress tests that exceed federal government requirements, Silicon Valley Bank can regain trust and demonstrate its ability to withstand any market conditions. Now I will hand it off to Roy for our next recommendation.
So our second recommendation is a increased focus on portfolio diversification, where money and clientele are spread out across multiple types of investments and industries. This process helps minimize risk while maintaining a consistent return on their investments. And the more diverse that portfolio is, it's more secure, which makes it highly attractive to depositors. And ideally, there would have been a balance of aggressive and safe investments so that the cash flows could meet both short-term and long-term goals. In the case of Silicon Valley, the bank should have invested into a variety of industries and securities rather than the primary startups and long-term mortgage bonds that they did, so that if one segment failed, they would still have been okay. So for the biggest financial incentive that could be given to the banks would be maintaining a diverse portfolio would be by decreasing the Fed funds rate. This law requires banks to maintain a percentage of their income on reserve. The more money they have to hold on reserve, that is less money that's being lent out and earning interest. So ultimately means that they are losing their money. And according to the Federal Reserve, the current rate is 5%. So if a bank held a certain level of diversity, it could be beneficial to lower that percentage and allow them to lend out more money since they are more security and investment.
So one of the reasons why depositors withdrew billions of dollars from SVB over the course of a single day is partially the speed at which information spreads over social media and virtual chat rooms such as Reddit and Discord. So for our digital element, we decided to use a social media campaign that would be focused on building connections with clients and sharing financial plans. This campaign would emphasize SVB's response to specific economic and political events and their plan to further client interests. And most importantly, this information would be accessed quickly by depositors in a familiar way that's already well-founded in social media advertising practices used by almost every major company. So here is an example of what a social media post by SVB might look like. This example in particular focuses on future investing prospects in response to the 2022 CHIPS Act, which would appeal to SVB's primary customer base, which is tech startups. And additionally, this would demonstrate to clients that SVB's investment practices are sound and in the interest of both the bank and depositors, increasing overall transparency. Finally, using a virtual platform to conduct this meeting would give clients nationwide a chance to interact and connect with their bankers and ask any questions about how their money is being managed and invested and how they're protecting their interests. Our final recommendation is that SVB increases both internal and external controls to help prevent bank failure. According to Allison Morrow of CNN, Silicon Valley Bank did not have a chief risk officer for 8 months prior to their collapse. And we think this would be a critical position to help identify factors that could lead to a bank run, and that SVB should retain a CRO indefinitely. or at least outsource their risk analysis needs to outside consulting firms such as Guidehouse or McKinsey. Furthermore, we think SVB should improve their deposit insurance standards, which according to Alistair Barr of Business Insider, left around 90% of their deposits uninsured by the FDIC. So for a quick comparison, Bank of America leaves around 32% of their deposits uninsured. And we think it would have helped prevent complete collapse if SVB's capital insurance practices were a little closer to the national average, that being around 30 or 40%. Finally, increasing oversight by fiscal watchdogs such as the Federal Reserve and FDIC in the form of outside regulation could help curtail poor investment practices. And now when you talk about increasing government regulations, there are always concerns about damaging the free market. However, government intervention in corporate America is already well-rooted in historic precedent, that being the Sherman Antitrust Act, numerous insider trading laws, etc. So a small increase in regulatory standards could go a long way in protecting stakeholder interests.
So for the counterclaims, the biggest counterclaim was a political one. An article written by Euronews stated that some believe that the so-called too big to fail bill signed under the Trump administration was to blame. This bill dictated that some institutions were simply too big and would have a very negative impact on the economy if they had gone under. This bill increased the oversight of banks holding at least 50 billion up to 250 billion. This shift meant that the banks holding over 250 billion would face regulations that were more strict on maintaining investment standards and management practices than their smaller counterparts. And at this time, Silicon Valley had around 200 billion, which meant they would be exempt for all these regulations. And then there was also a public congressman, Ronnie Jackson, notoriously blamed the Silicon Valley downfall on their woke agenda and says that they invested too much into diversity and inclusion incentives. Overall, there were numerous opinions on why Silicon Valley Bank failed, but the broad consensus is that the bank collapsed due to internal issues rather than the external political or economic factors.
So, okay, despite all of the failure of the bank and the red flags that we just told you about, there is a lot that we can learn actually from the collapse of Silicon Valley Bank. And it actually has given us a greater awareness of the different indicators pointing to instability in the banking market now. We're also able now to use this failure as an example to allow for a higher degree of preparation and preventative measures to be put in place to protect against bank runs in the future. By implementing the policies and practices we discussed today, we'll also be able to give regulators and clients the opportunity to come together and further discuss the interests of individuals, businesses, and banks. And we are also working to repair the trust between banks and depositors through our revised standard and transparent management practices that we mentioned, which should help to create a healthier and more secure banking system in the long run. Looking forward, we hope that focusing on constructing a comprehensive set of banking reforms to help with the fluctuating economic trends would help to prevent a future bank collapse. From the Great Depression of the 1930s to the 2008 recession, we know banks can grow from past mistakes, and through the collective efforts of businesses and management, we believe that Silicon Valley Bank may one day be able to reopen. We've also included a slide of our references in case anyone's wanting to look up more. But other than that, thank you for listening.